Hey traders, Steven here with TradersPlan.com. It is Thursday, May the 16th. Today we're going to do something a little different than we have the last couple weeks. The last couple weeks we went in depth into market analysis, industry sector analysis, all that scans, all that fun stuff. Today is going to be a really nice topic. We're going to spend just a little bit of time looking at the price action of the overall market. But, I shot a exit algorithm webinar earlier in the year showing you my top 20 trades, or showing you my 20 trades, and showing you what would have happened to those scenarios if you would have used different exit algorithms, right? Just to show you the power of, how important just changing an exit strategy is. I know everybody puts an emphasis on entry and the holy grail, but I think I'm going to show you today, and I'm actually really excited about it, that exits probably matter more. So we're going to look at that today. I was going to wait until I had another 20 trades so we can look at a full sample size. I don't have a full 20 trades, but I'm getting enough data where I think it's worth updating everything. Plus, this has been a very popular topic, a lot of engagement, a lot of feedback, a lot of criticism. I'm open for either or, just as long as it's polite. So let's get started with the market, and then we're going to go into the exit algorithm. So, let's just start with the S&P 500. I'm looking at this chart, and right now we're really just in a pullback. Okay. So what was really interesting is on Thursday and Friday you had these two reversal bars right here, and to me, that just goes to show you sometimes how important a 50-day moving average is. That's why I love it, because, it works. Now, it didn't work this time, but, look at, on Thursday, it went below the 50-day and closed back above it. On Friday, it went, it completely swallowed the previous candle and closed above the 50-day moving average. If I were a betting man, I would have said on Monday, the market is going to pop, and boy, was I wrong. Tariff news came in, and then you had this big red bar. I think the Nasdaq was down over 3.5%. Absolutely everything got slaughtered. Now, I'm not typically a fan of buying just immediately after something like this happens, but sometimes, you want to slowly test the waters to see if, buying a pullback is going to work. The reason why I'm not always a fan of just diving back in is because most of the times, it's not V-shaped like this. When you get, you'll have these little pullbacks that can be V-shaped, but a lot of times you get, just kind of a hard down. It'll pop, and it'll pop strong, and then it'll come back down a little bit. So, the market has popped good the last couple days, okay? So I'll give that to it, but I want to look at this just technically, from a technical setup. The S&P 500 still doesn't look great. It's under the 50-day. It's under the 20-day EMA, which is curling down. So right now, to me, I'm more looking at the 20 than the 50. I think that it could pop above the 50. But a lot of times what will happen is kind of like what you have on this side. You'll find support around that moving average a couple times in an uptrend. The same thing will happen on a downtrend. Like look over here, when it just started to kind of roll over, and then you get a pop and right into that line, and then it slams back down again. So I'm not saying that this is going to happen over here. I actually don't think this is going to happen. I'm open to anything, but my point is a lot of times you kind of want to wait for that first test and see what happens. Maybe you start to nibble here. I've been nibbling with a little bit of money to work. But I don't think we're out of the woods right now. So just kind of keep in mind, a lot of times when you have, a deeper pullback, sometimes it can pop and then it'll come back down and then kind of chop around a little bit, consolidate, and then it could head higher. So this is a heck of a move. And I think we all need to appreciate and understand that moves need time to digest those gains. So I don't know what's going to happen here. We could head out of here. We could consolidate for a while. We could roll over. I don't know what's going to happen right here. But I do know that, a lot of time, unless you're just in a roaring market, which we have been, but it's not going to last forever. Sometimes you get into a more challenging market where it needs to just consolidate, digest the gains before it moves higher. So now, if this bounces a little bit and then just kind of quickly rolls over and undercuts, you know, the 200 undercuts this Monday's low, then I might be a little bit more concerned. I wouldn't be overly concerned right now because I don't own a ton of stock, and it actually kind of worked out where, you know, I found myself kind of right in here just booking a bunch of profits, and then, you know, I had another position that got stopped out. So it's funny how there was one week where I sold 5 stocks and booked profits on all of them. I had one left. But it was all towards the top, and then, you know, this happened, it's interesting kind of how that works out, because a lot of times even close to the top stocks will start to get a little squirrely, and they'll start to show you a little bit, you know, of what could happen. So I think this right here is fine. I think we just kind of have to wait it out. But I wouldn't right now, in my opinion, be just totally backing up the truck. I'd be nibbling a little bit. But what was interesting is one thing I want to continue to point out on the S&P 500 price action is it just barely poked its head to an all-time high, and then just probably see this big volume bar probably just sucked everybody in, fear of missing out, and then boom. That's why a lot of times when you have these consolidations that are just kind of straight off the bottom or a cup, or they've already made a big move, a lot of times buying at the horizontal breakout is not a good play. We could also look at this like if it drifts downwards, it's just one giant cup with handle, right? You could have the shakeout pattern. So all interesting. One thing I do want to show you on the Nasdaq. So this is the zigzag chart, but I changed the zigzag to 5%. So any move right here is a 5% move up or down. So just wanted to show you in the last 2 years how often this really happens. You know, so you don't think the sky is falling. We have, I'm not going to count them all, but probably 25% moves one way or the other in the last 2 years. That's a lot, so this is very, very normal stuff. So I think right now we're just fine. And I still think right now you want to continue to be bullish until it's time to not be bullish. I think that'll just kind of pay for itself over time. Just because, you know, we came out so steep, but we do have the golden cross now. And even though if you buy right after the golden cross, it's not going to necessarily mean you have the very next trade as a winning trade, but more times than not, it means that it's, you know, you're going to re-enter a new long-term uptrend. Now in 2015 and 2016, we'll go look at that real quick. Let me look at that. We're going to look at that real quick where, actually, what moving average is that? No, that's the 20. I'll show you, the 50 real quick. So then I'll show you the simple moving average of the 200-day, where you did get the golden cross and then it failed and then it rolled back over. See? It came back above, but it was only briefly. I think right now our golden cross is looking a lot better because the 50 is way up here. So it doesn't mean it can't just go all the way come back. And I know that would frustrate everybody, but this was the most recent failures. And a lot of times when these golden cross, death cross failures happen, they typically happen pretty quickly. And right now, based on looking at this, I think we look a lot different right now and in a better situation. So if I go back to this chart, see we're already way up here. So we'll just kind of let it play and let it do its thing. I did want to look at small caps and just breath real quick before we move on to the exit algorithm part. You know, the Russell 2000 is not looking as good. You know, it just barely has. It honestly looks like it's going to roll, in my opinion. So you have two different indexes that are looking, in my opinion, completely different. You do have a golden cross, but man, this looks like it could fail because it popped above here, broke out of this consolidation, and it just came right back down. If I didn't see the S&P 500 first, I would absolutely say this is just going to absolutely roll over. So, you know, something to keep an eye on. I think you can always find a bearish case and you can always find a bullish case. I try, as long as we're in an uptrend, you know, I try to find the bullish case most often as I can. And, you know, and then if obviously if you have a bunch of things that are going wrong, then just sit back. But just because I'm trying to find a bullish case doesn't mean I'm buying with abandonment, you know. So this is the breadth on the short-term breadth. So you can see right here that the percent of stocks above their 20-day moving average in the S&P 500 is at 37%. We're really out of rally mode, and I think that's crystal clear based on the price action, but the breadth is still weak, right? So this might just mean pullback, consolidation, maybe even correction mode. I don't know. We'll just kind of have to sit this out, but it did dip below 30% there for a minute. So we'll just kind of have to keep an eye on this. I don't really see anything discretionary, industrial, healthcare. I'm not really seeing anything that is standing out outside of utilities, and that's not always a good sign. Utilities and staples, defensive, are holding up the best, which of course makes sense. So I just think right now, I just be cautious, but I'm still looking for bullish setups. And if I just look at the long-term breadth, we'll look at that real quick if I can find it. Yeah, we kind of went, the percent of S&P 500 stocks above the 200-day kind of dipped below that 60% briefly. Now, it did that on these two pullbacks too. So I think when you dip below 40, I think that's when you're getting into some bad territory, and we're not there. You can see 2015, 2016, the double dip, the failure at Golden Cross, which we already looked at, and then the bear market, of course, last year. We're not there yet. So, you know, if this kind of stays in the middle, just, you know, obviously we want this to be strong. We want more stocks pushing up the market, but right now there's just some yellow flags out there, so we'll just kind of keep an eye on it and see if the technical situation improves. So I'm keeping my eye on breadth, I'm keeping my eye on price, and we'll just kind of go from there. So let's go over to hold on just 1 second. Okay, I want to go over to the exit algorithm part of the webinar, and I really appreciate all the feedback I've received off this. I even received some criticism. Of course, it is easy to criticize hindsight, you know, but I think it's just a very good topic, and I think it's too important. Something like this is too important for my personal growth, for your personal growth, for me not to talk about it, not to share it. So for those of you who missed my previous webinar, what I did is I kind of want to cover this real quick, and then I'll add some updated trades, and then we'll look at the overall results. So what I did in the previous webinar, I said, okay, you know, let's take 20 trades and let's say, okay, what would have happened if I would have, you know, same entry on every single trade, absolutely the same entry, but what would have happened if I would have used a different exit strategy, okay? So I want to cover those exit strategies. So I call it E1, E2, E3, E4, E5. E1 is discretionary. Those were my actual results. And one reason why I share these with you is just to show you how much the human element, when you enter the human element into trading, can really negatively affect. So after 20 trades in the first part of the year, this was starting year to date, so this is this year, I only averaged 1.12% per trade. That is not good in my opinion, considering we were in a strong market, and last year I averaged like 3.57 per trade, okay? So I was not pleased with my results, even though at the time, the only thing that kind of kept me from keeping my head up was I was still beating the market, but I should have absolutely kicked the snot out of the market, in my opinion. So what's important, what the most important thing is, I think sometimes when you look at the absolute cold hard brutal facts, and then you put the rules in place to fix your issues, okay? So I think I was doing good. I was taking plenty of trades, but I was selling them way too early. So I averaged 1.12% per trade in the first 20 trades, 60% win ratio, and that is way below my historical average, or even last year's average, when it even wasn't that good of a year. So I threw together some different exit algorithms based on a course I was taking that talked about the importance of exit algorithms, and that's, you know, Dr. Van Tharp's Peak Performance course. It's all about risk management, but, you know, it really kind of inspired me, so I said, okay, let's put that to theory. What would have happened if I would have taken my exact same entries? Because what he talks about is taking the exact same entries and just changing the exits up to show you how different results you can have. So I said, okay, what if I take my same entry on all these different exits and say, on E2, I'm going to call it E2, I'm going to sell half at 8%, that's my target one, and I'm going to raise my stop to break even, or sell when the price breaks the 50-day simple moving average, whichever is first. So that immediately after I hit target one, I raise my stop to my entry. That way, if it kind of rolls back over, triggers me out on my second half, I netted 4% on the trade. 8% on the first half, 0% on the second half, 4%. I use the 50-day moving average as my trailer stop, right? So if the 50-day moving average moves above my entry, then that's the new stop. So whichever comes first. So E3 is sell half at 8%, use my original stop or 50-day moving average, whichever is first. So what that means is if I sell half at 8%, I'm not going to raise my stop to break even because it's likely a lot of times the stock will come back and test your entry, and I don't want to get stopped out early. So it's very similar but slightly different. Exit strategy number 4. I'm not going to sell anything. I'm just going to completely let it ride until it hits my original stop or the 50-day moving average, whichever is first. So this is true trend following, and we're going to see, how important. We're going to look at some interesting results here in a second, but this is true trend following. I'm not selling any half. It's a lot more difficult, but I'm just going to completely let it ride till it hits my stop or the 50-day moving average, whichever is first. Or E5 is you just sell all at 8%. So you just come there. You're not selling half. You're not letting the whole thing ride. You're just absolutely selling all at an 8% target. So you can see out of the 4, I have 4 different exit algorithms, how different the results can be. These are just completely different scenarios. So in E1, I got egg on my face. This was what I actually did. But if I would have used exit algorithm number 2, I would have averaged. Now this is the average net gain per trade. So what this is this means I take all my wins. I take this whole column right here, which totaled 22.35%, and I divided it by 20 trades to get your average net gain per trade. Right? That's just how I stacked them up against each other. If I would have done E2, I would have averaged 6.07% per trade. That's significantly better. So just taking the human element out of trading just had amazing results. So E3 is a little better than E2, and I always think E3 in the long term is going to do slightly better than E2. Not a ton better, but slightly better, because there are just going to be those trades, I think, in E2 where it comes back and it tests your entry and stops you out, where on E3 it's not going to stop you out so quickly. It's going to be a wider stop. So E3, where I sold half at 8%, I kept my original stop or the 50-day moving average, whichever first, did slightly better. E4, this is where I just completely, I bought it and it's either going to hit my stop and trigger me out as a loss, or it's just going to sell, the whole thing is going to sell after it breaks the 50-day moving average. Did the best, right? So it's interesting how you don't sell half. You're not selling half. You're not selling anything in a strength. You're just true trend following. You're letting it run. Or E5, you just sell the whole thing at 8%. Now, this isn't for me right here because I don't want to watch a big winner go away. But you might say, Steve, because you can look at it, you still would have averaged 6% per trade and you had an 85% win ratio. So this exit strategy had the best, or at least tied for the best, out of all of them. But what's interesting is that at least out of these 4, it had the worst performance. More on this here in a minute. So I just kind of wanted to recap this, just kind of remind everybody what we're trying to do. Now, you can see all are green and red, meaning there are no trades out of the first 20 that are still open. They've all broken their 50-day moving average or hit their target one, all of them. So all of them are closed, okay? Now, let's see. So just kind of want to show you. So you have, 85% win ratio on E2 and E5, but out of the 4, they have the lowest performance. They have the highest win ratio and the lowest performance. E4 has tied for the lowest win ratio, but has the best performance, right? So you can win less and make more. And then E3 is somewhere in the middle. This is, I think, what matches my personality the most is E3, right? Sell half at 8%, and then just try to let it ride as much as you can, right? Try is the key word. So let me actually raise this up for a second so I can bring in the other trades. Okay. So this is the next 12. This is the next 12 trades. So actually, I do want to undo that, and I want to say a couple things. One, I wasn't happy with these results, and I knew I had to fix my next 20. But I was fine because, one, a couple things. One, I was still beating the market somehow. I was still, or maybe slightly in line, slightly beating, but I was still up there. But two, I knew I could fix this with just a couple simple tweaks, because all I had to do was follow one of these exit strategies, and I could fix that. But I also told myself, and if you kind of go back and watch the webinar, I also told myself that I'm going to go after big winners. I'm going to go after stocks that can double, because I need a couple doubles this year to hit my financial objectives. Okay, so I said that. I'm telling you that to tell you this. Now, let's come back over here. Whoops. Oops, that's not there. Let's look at the next 12 trades. I don't have another 20 trades because I haven't taken another 20 trades, but let's look at the next 12 trades. So the next 12 trades, you can see right here. I have some really nice winners in here. The yellow means that, so this is the column of what I actually did, and these are E2, E3, E4, E5, so just to stack them. The yellow means, according to this exit strategy, I still should be in the trade, okay? So if we look at my next 12 trades, I improved significantly, so I fixed part of the problem. Notice I say part. I went from averaging a little bit over 1% net gain per trade in the first 20 to averaging 9.35% the following 12. I would say I significantly fixed a problem. You know, I plugged a hole. But the interesting thing is I still lagged the other ones. Here is the most mind-blowing thing to this. So this just continues to show you, even though I tried to do better. I tried to go after bigger winners, and I tried to sit through them. It was still very hard. So look at, and these results right here are just for the next 12 trades. On E2, you would have had a net gain on average of 13.6% per trade. That means every time you hit the buy button, win or lose, you're going to average 13.5% per trade. I'll take that for the rest of my life. And then E3 was 13.4%. So very similar. Here is the most mind-boggling thing to me right here. The difference between E4 and E5, and this is something that I was probably the most excited to show you, although I wanted to show you I did better, but this is something I'm the most excited to show you. 23.68% average net gain on these next 12 trades, and it only has a 42% win ratio. This has a 66% win ratio, 67%, but the average net gain is only 3%. So let's just say this is 3. Let's just say this is 24. So, you know, if I just kind of do some quick math, well, that says 79.5. That's not right. Hold on just one second. Okay, so the E4 is 8 times better. 8 times, produced 8 times better than the E5 that has a better win ratio. Okay, so just kind of let that sink in for a second. It only had a 42% win ratio on this batch of trades, and yet the average win was 24%. The E5, where you're selling half, you're never letting your dollars run, right? You're just selling half at 8%, selling half at 8%, had the best win ratio, or at least averaged the best win ratio, but you're only averaging 3% per trade. Now, let's look at all the results combined. Okay, so let me kind of move this over here. Oh, Okay, I had to fix the spreadsheet because copying and pasting sometimes formulas doesn't work. But I didn't want you to be too distracted. Okay. So these are all 32 trades, right? So I went from my personal results, I went from averaging a little bit over 1% per trade to the next batch averaging 9.35%, averaging me 4.21% net gain per trade for the year. So I'm already doing better than I did last year. Last year I did 3.57 net gain if you average out all the trades. So my goal is to get at least 5 for the year. I think that if I can average a 5% gain per trade average, I'm going to have a really, really good year. After looking at these results, I think I can do a lot better than that because I'm really just playing from behind so much. So those are my actual results. The win ratio of 62.5%. That's typically where I'm at. However, E2 did 8.9%. E3 did 9.06, so a little bit better, and that's about what you're going to have. Look at E4, and this is what I keep coming back to. E4, out of 32 trades, you would have averaged, if you just would have taken my picks and only sold if it hit one of two things, your original stop or the 50-day moving average, whichever comes first. Right? True trend following. Averaged 13.14% net gain per trade. And it had the lowest win ratio. E5, which is just sell the whole thing at 8%, averaged 4.91% per trade. Still pretty good, but had the highest win ratio, or at least the highest average, okay? So it's what's really interesting. I think this is kind of mind-blowing to me. And if you've ever read the book Trend Following, just the book Trend Following, I think Michael Covel, Covel, if that's how you pronounce it. He does a really good job explaining the best trend followers in the world, right? I mean, a lot of them are only averaging a 40% win ratio. He's averaged the best hedge fund guys, going back. But it's interesting because 90% of their profits are made from 10% of the trades. So I want to repeat, 90% of a true trend following profits are made from 10% of the trades. That might not be a good fit for you. But I think just looking at E4 and studying it just goes to show you, to me, what I see is how well trend following works. And it works because it's so hard to do. Let me talk about why it's so hard to do. You have the lowest win ratio out of all of these exit strategies, but you have the best results by far. But when you have a low win ratio of, let's just say 50% or even 40%, you're going to have some string of losses. And right here, trades 16 through 21, that was 6 losses in a row. Okay? That's frustrating. Can you sit through 6 losses in a row and stick with your strategy? I think most people have sit through 6 losses in a row, but can you do it and continue the same strategy? But then look, boom, you got a couple doubles. They just absolutely pay for everything. And then, you have another 1, 2, 3, 4, 5, 6 out of 7 losses in a row. So you almost have back-to-back strings of 6 out of 7 or 6 straight. That's a hard thing to stick with. That is not for the faint of heart. I personally cannot do that. I can't sit through a strategy where I'm going to lose 6 in a row often and all the time. That's just part of the strategy. But then boom, you got your huge winners. And that just goes to show you, trend followers, true trend followers are making 90% of their money on just 10% of their trades. But why I think this is I think this E4 and E5, this kind of study, this case study is so important to think about. And it kind of blew my mind, is just to go to show you that, the highest win ratio, having the highest win ratio means you're going to end up with more money in the end. I've known that was for a long time a myth, because when I see these, newsletters out there promoting 90% win ratios or even better, I know that the gains are much smaller, okay? And I think it's important to stack just polar opposites against each other just to go to show you, you can have a win ratio of a lot less. There is a big difference between a 53% win ratio and a 78% win ratio. There's a big difference, right? A lot of people can't sit through this, but honestly, probably throughout this whole calendar year, you're going to see this win ratio dip even more. So there's a big difference, but it's almost a threefold difference in performance. It's really, really interesting data. And I think it just proves two real things. One, win ratios really aren't as important as you think they are. I think they just make people feel good because they're winning, but I don't think they realize how much they're cutting themselves off at the knee by exchanging small wins to potentially go for bigger wins. But to be fair, to go for bigger wins, you're going to have a lot of trades. You're going to have bigger losing, periods, right? So this only won 53% of the time, and that was in a good market. That was in an absolutely good market. Now, so I just want to absolutely bold that highlight to show you, I think that is the most important lesson one can learn. Can I sit through this? No. Now, you might say, Steven, I'd be tickled to death with 78% win ratio and just selling everything at 8%. If that's you, great. Like, you can take all my alerts, all my picks, and you can do that. And if that makes you happy, then that's fine. Me, that doesn't work for me because there's nothing more painful to me than watching a big winner take off without you. Nothing more painful. I'd rather take a string of losses than miss out on a big winner. That's me. I'm trying to show you these results to maybe empower you to, run your own box, right? Or run your own exit algorithm spreadsheet just to show you, look at your own P&L. What would have done, maybe you don't like the 50-day moving average. Maybe you like the ATRs. Maybe you like the RSIs. Well, I don't like those. I don't use those. I like the 50-day moving average. So if you like different strategies, maybe you like trailing stops. Well, take that and create 4 exit algorithms of your own and, figure it out. Figure out what's the best. I feel confident in telling you whether you use ATR, RSI, or any other stochastics, MACD, any other kind of thing. I feel confident in telling you that the more breathing room you give your stock, the better you're going to do if you're picking right. So now let's kind of dive into these individual trades for a second, because now I came across a problem that I didn't think I would come across. So I think it's a good problem, but now I'm trying to figure this out. So maybe you can give me some feedback, and maybe it's not a problem. That's something I'm toying with. So I said, I 100% said on this 20, to be clear, I am going after big winners. I need a couple doubles, okay? I really did not expect to get a couple big winners in my next batch of 12, but I did, right? I didn't expect it to happen so quick. So the reason I'm telling you that is because, I did receive some feedback. Well, Steven, you have all these outliers, big winners that you need to back out of your averages because they're skewing the numbers. And what I'm going to tell you, if that's what you're thinking, but I told you I was going to do it. That's what I'm saying. That is what trend following is. You cannot exclude the big winners because that's what you're planning on doing. You're planning on having a couple big winners that are going to be a bulk of the profits, right? And I told you I was going to do it. So why would I back them out now if I said, hey, this is what I'm going to do, and I did it? I'm not going to back them out of the results because that's what I'm going for, okay? But again, you can go for this over here. That's fine. You can still probably take some of my picks and do very, very well. That's fine because there's a lot of volatility in some of these others. But I want to start with this one, okay? I want to look at this one, then we can look at GBTC. Now, this is a crypto. I didn't send a live alert. I'm sorry. The reason I didn't, there were some, it happened very quickly when I took the trade, and there were some disclosures I didn't have that I needed to have, and I just did not have them at the time to be able to alert, feel comfortable. Let me replay it. Feel comfortable sending a live alert. So this was just kind of an internal trade. But I want to look at the difference between these, and this. And this was only 4.5% winner, but this was an excellent case study. So the reason why I'm shooting for E3 right here, But the reason why I lagged in this next batch of trades so much is because I came across a couple situations I wasn't expecting to come across. Right, again, I'm selling half at 8% right here and using the 50-day moving average as a stop. Let's look at these trades. Let me pull that up. So I want to look at this trade first because I know I'm going to get the most criticism on this one. So this was a stock I've been watching, was IPOing. I bought a couple times, one winner, one loser, and then all of a sudden I saw the volume pop and I bought right here, somewhere around 875, I think, as it was crossing these two levels, okay? So I bought, and I sent the alert, and it hit 8% the very next day. So I sold half, right? This is what I was not anticipating when I was going after just the fastest movers I could find. I was not anticipating for this to be at 50% in 4 days, 5 days. So here's the problem. Now this is kind of a good problem, but here's the problem with that. When it shoots up so quickly, now it is so far above your stop, because remember, I'm trying to replicate E3 as much as I can. So it got so far above my stop, sell half at 8 and then use the 50-day. The 50-day is way down here. So what do you do when it's 50% above your stop? And now you can trail it. I know what you're going to say. You can trail it. You can sell more. I know a bunch of the things, but I was struggling with that, right? One, I didn't want to do that because I wanted to let it pull back, right? That's the idea of the 50-day SMA is a slow trailing stop, but it is a trailing stop. I wanted to give it an opportunity to pull back. And it didn't work out. It shot straight up. I had a 50% winner, at least on the second half, and it just came right back down and crashed through. Now, there's a couple things that I'm proud about, and I know some people aren't, but I am. I stuck to my plan. My plan was to sell half at 8 and sell half when it breaks the 50-day, and that's exactly what I did, right? And the fact that a bad result, just because it was a bad result, doesn't mean it was a bad decision. This could have easily came back, found support, and then shot to the moon, and then we'd probably still be talking about this, but I wouldn't be criticized as much. So I stuck to my rules, and it was hard to do that, but you had a potential huge winner, and it didn't go according to plan. So the conundrum is, okay, I'm not actually angry at this trade at all. I'm actually proud of myself for sticking to my rules. That's not an easy thing to do when you let this big of a winner pull back. But here's something to consider. For the doubles, they're going to pull back, and they're going to pull back hard. They're not going to go straight up and take off to the moon forever. Like, that is a reality. You have to be willing to sit through some gut-wrenching pullbacks if you're hoping out for bigger gains, right? And that's trend following as well. You're going to be willing to give up gains, right, when it pulls back to potentially see if it can find support and get you even bigger gains. That's the definition of trend following. So this is the issue I'm having, right? And I'm showing you that. So this happened, right? So I ended up selling it for a 4% gain. But here's also something to consider. E4, which is sell nothing, this ended up being a losing trade. So that's a very hard thing to do. Look over here. You had a potential 50% winner. Now that's if you sold at the exact top, come back down and turn into a loser. That's why the E4 is so hard, and that's why 99% of people can't do it, me included. Because this was hard enough to sit through, but watching this coming back. But again, this isn't going to happen if you're buying the Amazons of the world. You're not going to have it shoot straight. I mean, this is going to happen if you're just swinging for home runs here. Okay? You're going to get some that go straight up. You're going to get some that come straight down. So I'm showing you that to show you my other big winner. So I actually stuck with my rules on this one, and it messed with me on this one. Okay? So I had this one. I was in love with it. I thought I almost knew this was going to work, but I had no idea it was going to work this well. So I alerted this. I was literally on the beach, on vacation when it crossed. I mean, there was so much volume coming in it, and then it was just quietly pulling back to the 50. then it pulled back one more time. And all the pullbacks were quiet. So I said, you know what, when it crosses this pivot right here, I'm in. That's exactly what happened. I alerted it at $5.18. I was in. It popped. I sold half at 8%. It pulled back to close to my buy point. I was still in it because I had 50 days my stop. Then I went to the moon. Okay. So I really have the exact same problem, right? I went after a stock that just absolutely took off in a way that I wasn't expecting. I got a double, right? It doubled. I sold half at 8%, but the problem is I didn't stick with it, right? And then I sold the remaining half at like 115% gain. So I sold the second half at more than a double. Netted me like 66% on the trade, something like that. But it didn't hit the 50-day moving average. But the problem, I came across the same problem. When I was looking at selling this, or I sold part of it. I think I sold part of it on one of these days. I sold another half, and then I just sold the rest right here when the market started to come in. But when I was selling part of it right here, this stock was 75% above its 50-day moving average. What do? You've already sold half. The problem is, you can say, well, Steven, you can sell more. I know that's what you're going to say. But if you do that, you really don't have any meaningful stock left. Like, you sold half, you sold another half, then you got a little bit left. But if it's just a massive winner, like it is, then it's not going to move the needle on your portfolio, whatever stock you own left. Like, it's more just you're owning shares just to still feel like you have a little, so. And the reason, okay, so I had a decision to make. This was 75% above my stop because my stop was way down here. I just watched NIU. This was a couple weeks after NIU. I just watched NIU go from a 50% gain to a 4% gain. So it psychologically messed with me a little bit. And I was like, ugh. And I was also thinking of my paid subscribers. I was like, they're gonna, come after me with an axe if I let that happen again. So I let all these psychological things kind of mess with me. So I stuck with my rules on one trade, and I still say it was the right decision. It was one of the better trades I've ever made just because I stuck to the rules and it was so hard to do. But unfortunately, I picked the wrong one to stick to my rules, and this is why adding that human element just costs you so much money. Because I should have only sold half at 8% right around here. I should still be in my other half if I'd have stuck to my E3 rules. So right now I ended up selling the second half around 115%, sold half at 8, averaging about 64% gain. I should be in it based on yesterday's price. I should be up a net gain of 88%. So that's frustrating, right? Again, you kind of have back-to-back trades where you have a come-to-Jesus meeting with yourself. One, you stuck to your rules and it didn't work out. One, you didn't stick to your rules and you probably should have. But I'm going to ask you, and I know a lot of my paid subscribers, I know a lot of them were swing trading in and out of this. I can't do that. I'd rather sit through a pullback. That's just part of my personality. I just rather sit through a pullback because I'm so picky with my entries. I don't want to buy a pullback. Let's just see what happens. So this is funny. But what's amazing is if you just would have bought at 518, sold 0, right? You still have your whole position. You'd be up 169%. Okay. That's a massive, massive gain. This 169%, I just kind of want to prove a point. I'm adding up all the losers in this E4. This 169%, it covers, there's only 88% worth of total losses here. It covers all your losses in 32 trades, and then you still have half of the gains left. That means every other trade, every other gain is just pure profits. So it's just kind of an interesting thing to think about. Okay, what do you do? I know you might have a trailer stop, you might have an ATR, you might have all this, but again, we all have to do what's comfortable. So let's look at this GBTC for a second. Okay. So, this was, this wasn't a swing trade. It was more of a long-term position. So I was kind of nibbling in here, right? I was buying a little bit, and then I had an add-on position right here. And it just, boom, took off. So this was my first crypto trade ever. I wouldn't say I'm uncomfortable with crypto, but I'm still trying to get comfortable with the idea of this being a tradable asset class. I don't have, some crypto account where I can trade crypto. I just bought the ETF or the trust, okay? Because that's what I'm most comfortable with. So I was noticing, long story short, it ended up going up, and it ended up going up pretty quickly. And again, I'll just remind you, I could not alert this because it had to do with some disclosures, cryptos that I didn't have at the time. But I bought this, and it just absolutely took off. Okay? I wasn't, again, you have something that is incredibly volatile. They got really, really far above its 50-day moving average, right? I think I sold on I might have even sold on this day. It just popped. It just went straight up, and I think I sold on this day. I just was like, you know what? I'll walk away with a 30% gain, 32% gain. I didn't sell half. I didn't have time to sell half, so it popped like this. I gave it a couple days, and I just hopped out. But obviously that was a mistake because, look at where it's at now. And it just goes to show you, when something is strong, how much stronger it can get. I'm not necessarily looking at this trade as a mistake. This was just my first crypto. I'm just still trying to get comfortable with the asset class, or at least that's the excuse I'm telling myself. Steven, it is what it is. This is your first crypto, whatever. Now you're comfortable with it. But, again, we go back to this. I sold at a 31.5% gain. If I used one of these exit strategies, E2 or E3, I'd still be in it. If I used E4, it would be more than a double. E5, you would have sold the whole thing at 8%. So, it all blows my mind, to be honest with you, just to show you how much of different results you can get from different exit strategies. So I just kind of want to recap. I want to recap what I think is incredibly important key takeaways for you to learn. One, if you're not happy with your results, you need to look at the cold hard facts in front of you. Do this for yourself. Doesn't have to be my exit strategies, can be your exit strategies. And then see how much the human element is affecting your trading, right? And then fix it. Say, okay, I'm not going to worry about, if you're not doing where you want to be this year, don't dwell on that. Say, okay, I can easily fix this, and then put some rules in place to fix it. So I would say I fixed my problem. But now I have new problems, okay? So now because of a couple of trades, I'm more than happy. I'm up a lot more than the market now, right? Completely fixed it. But I'm still lagging E2 and E3. I'm really still lagging E3 by quite a bit. And at least this batch, even on this batch where I did a lot better. And again, it's the human element, guys. It will affect you, but look at this. That blows my mind. So I think that's a key takeaway. Let's not do too much dwelling on the past. When you have issues in place, you need to look at the brutal facts, and you need to look for it. So if we go with the overall results, I'm still happy with my year-to-date results, and I'm still going to continue to go after big winners. This is probably, my win ratio, that's where it's going to be, in between 62 to 70%. That's where I'm always going to be. That's just my style. I know that's where I'm going to be, because I know that if I am, if I could have gone E3, I would have had 75% win ratio, but usually I'm a little bit less than that. But again, this to me is the key takeaway, that win ratios don't matter as much as you think they do. And letting your winners run matter the most, okay? Letting your winners run matter the most, but understanding that when you do that, you're going to have some issues that come across, right? You're going to have bigger strings of losses. You're going to have lower win ratios, but you're going to have more money. And I think at the end of the day, like, we all want more money. But again, I still think this is the best piece of data I can provide you. How good trend following works if you stick to it and take the human element out of it. And how much it'll cost you if you are just taking quick profits, worried about 3, 5, 6%. If you're always doing that, you're not going to do as good as you think you do, because you have to be right a lot. And that's another problem I have with this E5, where you're always taking profits and you're never willing to give back some gains in hopes of bigger gains. You just have to be right a ton. You have to be right a ton. And you have to be consistently, and that's a hard thing to do, where if you hit a big winner here and there, man, that can really cover some ground in your overall portfolio. So I hope this was helpful. I hope it inspires you. Let me know if you have any questions, any feedback. I'm open to it. Yeah, I think that's good.